A little more than half an hour till the opening bell on Wall Street. Joining us now to talk markets, Greg Branch, founder and managing partner at Veritas Financial Partners. Greg, good morning. Good to have you with us this morning. How are you seeing things right now? Just to set the scene, we've got, a stock market that's kind of gone sideways for several weeks, point to point. You had a 10% correction in the NASDAQ composite. Disruptive tech pulled back hard. You had the cyclical stocks doing great. Now they have settled back as yields have as well. Has that surfaced any opportunities? How would you tilt with this environment right now?
So I remain bullish with caveats, and I am particularly bullish still on the value sectors. When we first started talking about this pre-election, it was based on the deep discounts and multiples. That has largely been made up over the last few months. So my bullishness now relates to the earnings estimates being too low. In order to maintain those average multiples that we've reached, if the earnings are increasing, there's still performance here. And in many of these cyclical sectors and many of these value sectors, we're seeing earnings estimates that are 50% or 60% pre-pandemic levels. So I think that we have a second half story, earnings revision and earnings surprise story in the value sectors. There's also still select stories and growth that I like, but that gets to my caveats. Interest rates, we need to keep an eye on. And inflation, we need to keep an eye on. While the Fed is looking at 2.4%, 2.3% in core inflation, it may very well be more than that. We'll see. At the end of the day, the market will forecast the Fed's change in posture if we start to see those interest rates rise above that or be more persistent than the Fed is forecasting. That will obviously have an effect on yields. And when we see yields rising, that is most negative for growth and tech, as it affects their borrowing costs out into the future. And with growth in tech stocks, it is those future earning streams that we're actually valuing. We've seen value, on the other hand, have a high correlation to rising rates as those input costs are passed on. Most importantly, the rising yields may provide an overall headwind to the entire market because we've seen pools of money, municipalities, pension funds that typically look for less risky assets move up the risk curve. And as those yields rise, the danger is that those large pools of money may retreat to their traditional typical asset classes.
Yeah, we're also expecting, I think, a little bit of a rebalancing from accounts like that. Just in terms of those value sectors where you expect earnings estimates to have lots of upside, which in particular would you focus most on in terms of whether financials, energy, industrials?
Right. Well, if we believe we're in a rising rate environment, then obviously the banks are still an opportune sector. The net interest margin environment has been challenging. Rising rates obviously loosen that up a bit. I would continue to focus, though, on the banks that have the diversified platforms. Because if we remain in a challenging environment, those banks have proven that they have other sources of upside, other sources of profit drivers, and we've seen that they've started to release the significant amount of reserves that they had put away. So they should continue to deliver strong results. I'd look at retailers. As the economy unfolds, I think that we will see, obviously, a bounce back in retail, but I think the high savings rate has been really concentrated in the upper socioeconomic segments.
Right.
And so I really like value retailers because a lot of our citizenry will be looking for value as they reemerge into the economy. I particularly like those value retailers that are leveraging and in some cases weaponizing their retail capabilities.
Shepard Smith here. Thanks for watching CNBC on YouTube.